Hello everyone, my name is Ben Decker, and today I'm going to go over the NOB spread, which is a yield curve trade. So NOB, NOB stands for notes over bonds. So notes /ZN is the 10-year treasury note, and bonds /CB is the 30-year treasury bond. So the NOB spread is just trading the 10-year note versus the 30-year bond. It's a pairs trade where you're long one and short the other. So ZN and ZB are CME futures products. They're pretty old products. They're also very large products. And these products aren't actually the yield. So it's the actual note and the actual bond, and the yields are the inverse. So if ZN is going down, that means yields are going up. And if bonds are going down, same thing, the yields are going up. So typically with this NOB spread with ZN and ZB, you're usually long 2 notes or short 2 notes to 1 bond. So I'm just going to pull up here how much that would be. So 1 bond, 1 /ZB product is about $4,400, and 1 /ZN is $1,500. So 2 of these would be $3,000 plus the $4,500. You're looking at about $7,500 to put on 1 NOB spread. So that's quite a bit of capital to put up for 1 position for a typical retail trader. Along with these actually being the yields being the inverse, it makes it a little bit more complicated. So for the NOB spread today, I'm going to talk about a new product that just came out actually this week, using the small exchange futures instead of the CME futures. So to get to the small exchange futures in tastyworks, I'm going to go over to the watch lists. I'm going to go to presets, and I'm going to scroll down to futures small exchange. Left hand side, all the small exchange futures will pop up. These are relatively new. At the top here we have the 3 yield products that they have right now. So we have S2Y, S10Y, and S30Y, and this is the 2-year, the 10-year, and the 30 yield rate products. So the cool thing about these products is instead of the ZN and ZB, which actually track the note and bond prices, these are actually the yield prices, and they make it pretty easy. So if we go to, for example, the S10Y here, the last price was 14.21, and actually what this means is that the 10-year yield is actually 1.421. So it's you just move the decimal point one spot over, and that's the percentage. So the 30Y here, it's 2.152%. So the yields are really easy to determine instead of the ZN and ZB product, so it makes a lot more intuitive sense. I'm just going to point out here that the /S2Y, S10Y, and S30Y, these are the actual futures products. So this is what is being traded right now. If you want to know what the actual yield is, you have to look at the index prices, and that's given by these 3 products here. So 2Y SME, 10Y, 30Y. So these are going to vary a little bit, but at expiration of the future, this is what they'll settle to. Alright, so in tastyworks, I'm going to go to the trade tab here. I'm going to go up to pairs, and here is where I'm going to put in the /S10Y and the /S30Y. If I pop this out here, this gives a if I were to buy the S10Y and sell the S30Y, this is the chart. Since this product just came out this week, there's not much data, so I'm actually going to show this with the index instead of the actual futures price. So if I go 10Y SME there, and here if I go 30Y SME and pop that out, it gives a little bit more data. So here it only goes back to December because this is a relatively new exchange, so they don't have a whole lot of data yet. But you can kind of see this is kind of a downtrend with the pop yesterday and today. So if I swap this where I'm selling the 30Y and buying the 10Y, you can see kind of the opposite, where this is kind of an uptrend minus yesterday and today. So before I go further, I wanted to explain what an inverted yield curve is. So you might have heard that term before COVID. Back in, I think, 2018, the yield curve went inverted, and it seemed like everyone was talking about it. Not everyone knows what it means, so I thought I'd talk about it here and set up a trade assuming that the yield curve went inverted again. So a typical yield curve structure is for longer durations, there's a higher rate. So you can see here, as we go from 2-year, 10-year to 30-year, the yield rates go up, and that's what you would expect. An inverted yield curve is when, for example, the 10-year would be above the 30-year. So if the 10-year yield was, say, 2.2%, we would say that the yield curve is inverted. So let's pretend that the yield curve is inverted and that we expected the curve to go back to normal. So in order for the curve to go back to normal, we would want the S10Y to go down and the S30Y to go up. And that would cause the rates to diverge. So actually this pairs trade here is set up properly. So if we ever went inverted on the yield curve, I would put on this trade, and this trade would benefit for a normalizing yield curve. If the rates got to an extreme where the 30Y was way higher than the 10Y, then I would do the opposite, where I would buy the 10Y and sell the 30Y. So that's the NOB spread basics. It sounds a lot more complicated than it really is, and actually using these S10Y and S30Y products makes it a lot simpler compared to ZB and ZN. So if you guys have any questions, feel free to leave them in the comments. Feel free to hit the like and subscribe button if you thought this was helpful. Any feedback would be awesome if you want to see anything else in future videos. Otherwise, thanks for watching.